As you can tell by the title, we're back for another episode of Tax VAR where we hand out red cards, yellow cards, or we agree with the on-field decision depending on what tax advice is being shared on social media. My name is Ronnie Fogan. I'm a Canadian and American CPA, and my purpose is to help generate 4 to 5 figure tax savings for content creators on a yearly basis. Let's hop right into it.
Don't ever let your parents give you their house. Instead, do as the rich do. Well, kid, I'm getting pretty old, so I'm giving you the house. No, Mom, that's a terrible idea. Do not do that. Well, I wasn't expecting that reaction. I thought you would be thrilled. Of course.
A lot of parents have this misconception when they're writing up their will and estate planning. They're like, hey, I gotta give the house to my kid. But we'll find out that it's often best, especially in the US scenario, not to do anything. You want the step up in basis to occur so that your kid doesn't have to pay any tax once acquiring the property.
Of course I want the house, but you bought this house 50 years ago for $200,000. Now it's worth $1.2 million.
We don't want $1 million in capital gains. We want to find a way to avoid it. Let's see what she's going to tell us.
I'd pay an insane amount of capital gains taxes.
That's
How
right.
much? Let's calculate it. It gained $1 million in value, so the total taxes I would owe over $340,000. What do we do? You're going to put the home in a living
$1 million in capital gains, and we're paying about 33% of that in capital gains tax. I would say this is a long-term asset, so we'd have the long-term capital gains tax rates applied. I don't know if that rate is accurate, but we'll go with it.
trust and then add me, the beneficiary. Okay.
Ooh, what? What? No. Living trust for transferring ownership of a home in the United States jurisdiction? If our goal is to leverage the step up in basis that happens when a home is passed on, when the parent passes away and the kid is the beneficiary, there's absolutely no need for a living trust to be set up. You're literally telling your audience to incur additional fees to have the same outcome that they would have if they had done nothing. If you're a parent in the United States and you want to pass on your house to your kid in the most tax efficient manner, do nothing. There is something called step up in basis in the United States, which pretty much means they're going to take the fair market value of your home. As the lady in the example mentioned, the home went from $200K of a cost, that's how much they bought it for 50 years ago, and it's now $1.2 million. So there's $1 million of a capital gain. We don't want to pay this tax. Step up in basis applies where at the time of death, the home's adjusted cost base is going to be adjusted to its fair market value. The proceeds are 1.2 million. The cost is 200K, but we're going to say that the new cost base for the beneficiary is 1.2 million. So if the proceeds are equal to the adjusted cost base, we have a net zero capital gain, which means no taxes are incurred. Based on this lady's video, that's a clear red card. Please do not set up a living trust if your sole purpose is to pass on your primary residence to your kid. You do not want to have to pay trustee fees, setup fees, just to have that single outcome. For more legitimate tax advice and critical VAR reviews, make sure to click that follow button. I'll see you in the next video.